Welcome back. In its latest board meeting, market regulator Sebi has approved a series of key measures which are aimed at protecting investor interest and improving the various aspects of market regulation. Yash is here with the key highlights. Yash.
Well, Rima, a total of 19 items got SEBI's approval in yesterday's board meeting. The three most important out of them, and to start with the most important out of those three as well, was with respect to the regulations that came as far as the SME IPO, the small and medium enterprises IPO side is concerned. Multiple things got approved, things like companies seeking an approval from SEBI should have an operating profit of 1 crore for the preceding 2 years out of 3 last years. OFS portion, that is offer for sale, cannot exceed 20% of the issue size. Promoters looking to repay any of the debt through funds raised via IPO will not get approval. Selling shareholders cannot sell 50%, more than 50% of their holding. Promoter lock-in in excess of the minimum promoter contribution will be released 50% after the first year and the balance 50% after 2 years. Allocation under NII category, that is the HNI category, will be via draw of lot method. And finally, related party transactions or RPT norms will be applicable on SME as well. Merchant bankers, a few restrictions came on that side as well with respect to the businesses that they can do under SEBI's purview. For other businesses which are not permitted, they'll have to register a separate brand, separate entity, get the approval from the respective regulator, and only then they can do those businesses as well. Insider trading regulations also saw some of the approvals coming in. Importantly, 17 new items got added to the definition of unpublished price-sensitive information. These 17 new items will now require disclosure from the management going forward as well.
Okay, all right, Yash, thank you so much for telling us and summarizing the big takeaways from the SEBI board outcome yesterday. But to discuss more on this, Sandeep Parekh, Managing Partner and Founder of Finsec Law Advisors, and Moin, Ladha, the partner at Khaitan and Company, is joining us now. Gentlemen, good morning. Thank you so much for joining in. Sandeep, let me start with you. Just the first reaction specifically on the SME bit. Do you think this largely addresses the issue that the regulator has, or more was needed and this is slightly softer for the industry than what was expected?
Right. So I think it's actually, if you look at it from the SME IPO norms, they've tightened it very, very significantly. It's a lot of tough love for people who kind of going in for these alternate listings that we call SME listing. So a lot of restrictions in terms of profitability, what, how you can enter, the kind of lock-ins. The RPT has been kind of tightened a lot because, again, a lot of it must be coming from experience. But it certainly appears like, they're not happy with what has been happening in the SME IPO route, and therefore they're kind of significantly tightening who can come, how much they can raise, how long they get capped up for, and also bringing in many of the norms of related party which are applicable to main board companies. So I would say it'll make life much, much tougher for, justifiably or not, of course, we can discuss, but it will make life much tougher for people who want to come for an SME IPO.
Sandeep, let's talk about the justification, right? Tough love, as you called it, for SME IPOs. And we've seen some crazy subscriptions for many of the companies that got listed on the SME board last year. According to you, which of the regulations or restrictions are a little excessive, maybe unnecessary or, excessive, according to you?
So, I mean, see, there are two ways of looking at it. My perspective is, regulator's job is not to remove foolishness from the market. It's to remove kind of ignorance. So this is, these are very substantive changes. And again, there'll always be two camps, two philosophies which will battle whether to kind of curb these kind of IPOs by substantive restrictions and kind of what you can do, what you can't do, which is what we had before 1988, which is a merit-based system in which people, in fact, pre-1988, companies had to ask the government that they want to raise X amount of capital at X, Y price. So I think SEBI obviously has been unhappy with the kind of the excess froth which has been. But again, like I said, is this the correct way to do it? I'm not very sure about that, because ultimately, people will have to learn that there is no free money in the world, and SME IPOs. We've had one example where a small workshop with like 8 employees or 12 employees got multiple times subscription for literally 2 shops that he ran. So I mean, we've had a lot of craziness that's bound to go away in any case. But I think restricting is there are 2 ways to do it. One is to improve disclosures, the other is to kind of have substantive restrictions, which is what I think Sebi seems to have chosen route number 2.
Okay. Moin, coming on this, your thoughts on this? Do you think something else that can be added? There were a lot of issues raised by the regulator as well. Do you think all of it and most of it has been addressed?
I think, as Sandeep mentioned, right, one cannot completely comment on whether all the issues have been addressed, but going to why SEBI has done this, there have been some strange, sort of success stories of SME IPOs. There's been a suspicion of, money being raised and, diverted in some other way, repaid to the promoter, pending loans. All of these seems to have now been attempted to be, dealt with. But, we will only know how this, shapes up, whether this takes away the bullishness, takes away the opportunity from the SMEs, really. But my personal view really is that these seem to be positive steps. We've evolved even in the general main board listing rules. There used to be times when object or end use of IPO proceeds was not very clear. And all of these things coming in, gapping up some of these, related party-related conditions, also having clear requirements not to sort of use the IPO proceeds only to repay loans, or having stricter norms around that, I think is a positive step taken by SEBI, really.
But some of the conditions that have now been approved, for instance, operating profit for 2 out of the 3 years, that's not even there for the main board IPO. Now it's been introduced for the SME IPO, Moin. So comment on that. Do you think any of them could have been avoided? Has SEBI gone a little too far?
I think that condition is something that does make it unattractive and may make it restrictive for many companies who want to do this. However, there are other, other sort of proposals, like the lock-in, for example, restriction on how much can be used for general corporate purposes, restriction on how much of OFS can be really added. Those seem to be sort of logical changes. But I do agree that just having an operating profit for the last 3 years, if I'm not wrong, 2 out of 3 financial years, is something that's market-driven, industry-driven, and that's not something that rules out even companies listing on the main board, as you rightly mentioned.
Okay. Sandeep, then what do you think? There are some restrictions, as of course, we spoke about profits, right? Some of the restrictions that we've seen in the SME IPOs that should and could be applied to main board IPOs as well, because we also have seen a lot of main board IPOs which are not profitable, but they do make substantial listing gains.
No. I'm completely not in that camp at all. I think the problem with SME IPOs has been there's too much froth, and it's been pretty crazy. So I think this is kind of may not be the best way to, but this is the way SEBI is handling it. To restrict main board companies to have profits for 2 out of 3 years is kind of really bad move. And again, goes back to that pre-1988 move of government or some kind of bureaucrat or regulator trying to control the flow of capital. So long as it goes through a book building process, people are coming in with the eyes open. I really don't see that should come into the main board at all. People should be free to invest in loss-making companies, so long as many of these have long gestation periods, and therefore it's good to have those companies raise capital, scale up. We're seeing a lot of that money. We're beneficiaries of that, right? Every time you get your 10-minute delivery, it's probably come because of valuation which the kind of capital many of these companies have raised through IPOs. So I think it's a lot of it can be productive. So I don't think many of these restrictions ought to be imposed on the main board.
Out of time, but we had some more questions on even the changes made to the unpublished sensitive information. But for another time, Sandeep, Moin, thank you very much for joining in on CNBC TV 18. Get into a break. On the other side, we'll talk fundamentals. Santosh Singh from Motilal Oswal Asset Management joins in.